Welcome to another episode of dooacademy. In early July, the US Federal Reserve leans towards raising rates to tackle persistent inflation. If you think this doesn't affect you, think again, because the Fed's decisions on interest rates can directly influence your everyday life. From the global stage to your local community, seemingly minor economic shifts can send shockwaves through the entire system. Join us as we delve into the fascinating realm of macroeconomics, exploring its indicators, policies, and influential factors. Macroeconomics encompasses the comprehensive study of the economy as a whole, of which economic growth is an important aspect. Economic growth refers to the sustained increase in a country's per capita income or output over an extended period. It is a primary objective of macroeconomic policy for most countries. However, how do we know that the economy is improving? To assess progress, economists rely on concrete indicators. Gross domestic product serves as the commonly used indicator to measure economic activity. It represents the total value of goods and services produced within a country during a specific time period, providing insight into a country's economic strength and resilience. Steady economic growth fosters increased wealth and employment opportunities, benefiting the entire population. Various factors contribute to economic growth, such as entrepreneurship, investment in research and development, education, and cultural influences. Renowned economist John Maynard Keynes identified consumption capacity, investment, and trade as key drivers of economic growth. Consumer spending serves as the primary driver of economic growth. It increases demand, prompting companies to expand production, create jobs, and boost profits, inspiring investor confidence. Let's take the United States as an example. In the United States, Chinese consumers contribute to 70% of economic growth, with service consumption accounting for 42% of GDP. US consumption power is remarkable. In 2019, total retail sales exceeded China's by $270.3 billion, despite the US having only 330 million people compared to China's 1.4 billion. Considering the population difference, one American's consumption power equals that of 4 Chinese citizens. This exceptional consumption power is a major driver of the US economy. Supply and demand form the foundation of economic principles, representing both producers and spenders. Investment and consumption capacity are vital for promoting economic growth. Investment involves buying or selling assets with future returns in mind and includes activities like research, hiring, and sales. The stock market, an economic engine, attracts significant investment due to its liquidity and ease of transactions. Confidence plays a key role, as a vibrant economy attracts competitive companies to list and trade, boosting stock prices. Investment allows companies to expand, innovate, and create jobs. Products often consist of multiple components, giving investors the option to source them locally or internationally. However, not everything can be produced domestically, so we rely on trade. Exporting products and services also stimulates economic growth by generating foreign exchange and boosting national tax revenue. Stable international trade fosters global connections, expands market share, and enhances influence, laying the groundwork for business expansion. Cross-border cooperation reduces costs, improves efficiency, and enhances competitiveness, resulting in better products and services. The central bank plays a vital role as a navigator to ensure balanced economic growth among these drivers. The central bank plays a crucial role in managing the national currency and ensuring economic stability. Various tools, such as buying financial assets from commercial banks and providing cash, stimulate economic growth through increased lending. However, an excessive money supply can lead to a lower value, similar to any commodity. Another effective tool utilized by central banks is the interest rate system. Lowering interest rates encourages borrowing and spending but may lead to inflation and currency devaluation. While low interest rates stimulate trade between countries but can also cause inflation and deter investors. In turn, high inflation rates can devalue a country's currency, making it less attractive for investors. The central bank aims to achieve a balanced money supply to facilitate economic transactions, promote investment, and support growth without causing excessive inflation or deflation. A rate hike can have far-reaching effects on savings, investment, consumption, corporate loans, and the stock market. With higher returns on fixed income products, such as deposits and bonds, saving becomes more appealing, leading to reduced consumption. The decline in consumption can result in lower demand for goods, prompting businesses to lower prices to stimulate spending and curb inflation. For investments, higher interest rates increase financing costs, leading to a reduction in loans. This can particularly impact companies heavily reliant on loans, potentially slowing down production. Moreover, rising interest rates discourage risky investments, with investors opting for stable returns from U.S. Treasury bonds over stocks. These changes in the financial landscape can significantly influence economic dynamics. Overall, understanding the big picture of the macroeconomy is crucial, as it reveals the interconnected relationship between the economy and interest rates. Changes in one aspect can have far-reaching implications for the entire system. What we're wondering, however, is that given the current state of the economy, do you agree with raising interest rates? Share your thoughts in the comments below. Be sure to like, share, and follow for more actionable investment insights.